Hello and welcome to this new edition of our investment strategy, in which we present our outlook for 2019. While global activity should moderate next year, we anticipate a fairly supportive context with growth at above potential levels across the main economies. Indeed, nothing suggests a recession in the US, a hard landing in China, or a dismantling of the Eurozone. The US economy should see a slower pace of growth and lose some of its outperformance against the Eurozone as the fiscal stimulus fades and headwinds facing European economies dissipate. Thanks to resilient domestic demand and a tightening labour market, the euro area should grow above trend despite uncertainties in the UK, Italy, France, or even Germany. Emerging markets look poised for some stabilization. An early stage cycle and sound fundamentals across major economies offer reason for optimism in spite of trade tensions, tighter monetary policy, a heavy political agenda, and volatile oil prices. And while China will continue to feel the effects of trade tensions, easing policy and past currency depreciation will provide some macro stability. Several macroeconomic and geopolitical factors could nevertheless cloud the prospects for the global economy. Investors will need to grapple with monetary policy convergence and tightening financial conditions across the globe as major Western central banks follow the Fed's path towards higher policy rates. Also, the trade dispute between the US and China will continue to impact confidence and markets. All told, this environment requires a cautious balance of risk and reward. So how should we position portfolios? Well, let's hear our latest views from Stéphane.
We are entering 2019 with a cautious, and by this we mean very cautious, yet optimistic stance. There are two reasons for this. Asset valuations are cheaper now that they have adapted to higher rates, and fundamentals are sound, as we just heard from Samy. Moreover, the inversion of the yield curve is unlikely to signal a bear market in the next 12 months, as history has repeatedly shown. Yet, we are moving to a more volatile phase where tighter monetary policies, rising inflation, and increased political uncertainty will continue to spark investors' concerns. In portfolios, this translates into a prudent asset allocation where robust corporate profitability continues to support selective exposure to risk assets. At one end of the spectrum, we hold equities, at the other, cash to balance the active risk. Cash will also allow us to respond to attractive opportunities next year. Solid corporate fundamentals and undemanding valuations underpin our preference for equities. In fixed income, we have increased exposure to short-term sovereign debt and inflation-linked securities, as the latter helps preserve capital from rising inflation. In currencies, we expect the US dollar to depreciate as the US fiscal expansion fades and the rate differential between the US and the rest of the world narrows. We are short the US dollar by as much as 5%, 3% against the yen, and 2% against the euro. Turning to risks, we see three main threats to investor sentiment. First, an overheating US economy that will force the Fed to accelerate its hiking cycle. Second, a full-blown trade war between the US and China. And finally, heightened geopolitical and social tension across the globe. Another important unknown at this stage is whether the Fed will continue at the announced pace, we expect 3 hikes for 2019, or whether it will pause to assess the impact of its tightening on the economy and the likelihood of a recession. This will be very significant for markets. Investment discipline remains crucial, as this maturing expansion brings forth fresh investment challenges for next year. We will keep our risk exposure appropriate to the evolution of the cycle and continue to focus on asset quality and liquidity, both critical for portfolio resilience. We'd like to conclude this edition by wishing you and your family a very happy holiday season and a prosperous 2019. Thank you very much for watching.